welcome back to my channel. We had such a great reception from breaking down the triple net properties last week that I asked George to come back and really walk us through another asset class. And today we're going to do multifamily assets. So George, thank you for coming on today.
Well, thanks for having me over.
Now, for those that you don't know, George is a CEO of Commercial Brokers International in Los Angeles. I've had him on several times if you go back and look at the channel. And we did this breaking down these triple net properties last week, and it was so well received. People were DMing me, asking me if we could get George on and do multifamily assets. So that's why we're here today. George, how many properties do you have for us to look at?
Actually, I thought we'd just take a look at one property, but I want to point out certain key things that an investor or anybody should be looking when they're analyzing that property for their investment.
Okay.
And also what to be aware of when it comes to when you're looking at marketing materials and offering memorandums.
Okay. All right. Very detailed.
Okay.
So let's get started.
Absolutely. So, typically speaking, whenever you're going to look at a property, especially multifamily property, you're going to want to have a technical review of the property. First and foremost is key metrics. So the key metrics most investors use: price per unit, price per door is something I actually do because I break down the unit. A lot of people just look at units and price per unit.
Yeah, price.
And
yeah.
The bottom line, though, is that if you have a building, a 10-unit building that's all 2-bedroom, 2 bathrooms, and you have a 10-unit building that's all single units or bachelor
That
studios,
price per unit be way
that
off.
price per unit is going to be completely different. So you can't really compare that. So I break it down to price per door, and I actually assign numbers to the unit types, and then divide that out, and then get a much more realistic number that will be equivalent, so I can actually compare comparable properties that are 2 bedrooms versus like a studio.
Can you break down how you do that?
Absolutely. Well, typically it's pretty easy. I do have a proprietary formula, but so I'm gonna go over the general aspect of it.
Okay.
But generally speaking, what we do is for every bathroom we count that as 1 door. For every bedroom we count that as 1 door as well. But then like a studio would be a half door because there's not really a bedroom; it's just a living area itself. So essentially that's it. There's a little bit more into it, a little fine tuning,
Right.
but
it gives you a more realistic number.
it gives a extremely realistic number where the differentials are not so great when you look at the comp sets.
Yep.
So price per square foot, everyone hears that, knows that. That's the price per square foot of the actual building size. Gross rent multiplier. This is used a lot of times for investors who many times they don't really understand a capitalization rate, or they can figure that, we have traditional numbers. I think it can be used in conjunction with the capitalization rate, which is a much better financial tool for estimating value. Because if you have for instance, a high gross rent multiplier, but then a low cap rate, you know that there might be expenses that you can cut them out to make a savings, and then actually raise that cap rate over. So you can use the two in conjunction with another. Also, parking spaces per unit and type of parking, things to look out for. Meaning when you're looking at the comp set, one building may have 2 parking spaces per unit, one building may have no parking spaces. That's going to affect pricing. You've got to take that into consideration. From there, we're also looking at the technical review of the property itself. We're looking at the building layout. How do the units look? How are they laid out? Are they efficient to actually live there? The unit mix is also included in that. If I'm looking at an investment, I'm looking at unit mix because typically speaking, studios and 1-bedrooms have a higher turnover rate, so you can expect a higher overall vacancy. So you want to take that all into consideration when you're building your financial analysis, so that you're taking the vacancy rate off your gross income to get your gross operating income. Building amenities. What amenities are in the building? Are there any? Is there a dog run? Is there a common area laundry? Is there a pool? Is there a gym? Bike racks, bike room, all that stuff. Zoning is also very important. Okay, now a lot of people actually skip over this. They figure that if the building's already built there, it's zoned for it. Well, zoning changes, as we all know. And one of the things that you have to be aware of is that with a zoning change, your building may be substandard to current zoning requirements. So if something happens where the property's burnt down, you may not be able to rebuild it exactly to what it was previously. You may actually lose units.
Oh yeah.
So those are things to take into consideration.
I had a meeting this weekend, and we got onto lot lines. The current property is grandfathered in. It's lot line to lot line.
Yeah.
If they demo, They're
then
gonna
you're
have
gonna have
setbacks.
setbacks and everything, absolutely.
Yeah.
So those are things to really be aware of when you're taking a look at it, but then also you have zoning overlays. Be aware of the zoning overlays, and you can actually hire a company, they call it a PZR, Property Zoning Report, which will give you all this information as well. A good broker can also pull some of that information and show it to you and give it to you from the public records.
What's the cost of a PZR report
PZR report, generally speaking, is
in your market?
anywhere from $500 to $1,200 depending on the submarket.
Worth it. Okay.
Yep, absolutely. And then in addition to that, the zoning overlays are also going to give you, like for instance in Los Angeles, we have what we call transit-oriented corridors, TOC.
Right.
This will give you your, that's an overlay depending on where the transit is within the area, and they have different zones, tier 1, tier 2, tier 3, tier 4, but they allow for bonus density for redevelopment for a possible exit strategy. So, you know, those are things to take into consideration because that also affects what the highest and best use is. Meaning, you may have a property and you're taking the valuation of it and looking at it straight as an investment key point, but it may be have a very low FAR or floor area ratio compared to the lot size, and you can build a whole lot more, especially with a zoning bonus or a density bonus. And the land itself may be actually worth more than the land in the building.
Sure.
So that's part of the analysis that you take a look at. And then you want to look at current rent versus market rent. In the industry, it's called loss to lease. So when you're stuck in a lease or you've signed a lease but the market rents have gone that much higher, the differential is what they call loss to lease. Be aware though, in some municipalities where there's rent control, you can't necessarily raise all the way up to market rate rent. You know, it depends on what that differential is. So that's what you want to take a look at, so you have a full understanding what your expected returns are going to be over the next 2, 3, 4, 5 years.
Well, now also performer rents. You got to watch
Yep.
out.
Well, that's one of the things to watch out for when
Yeah.
it comes to offering memorandums. Okay,
Yeah.
remember an offering memorandum. You know, when they talk about pro forma rents or when they talk about actual expenses, you have to be aware that it may not necessarily be your true numbers when you get and purchase the property. A broker's job a lot of times is to make the property look more appealing. And I don't mean that they're going to lie about it, but they're going to push the envelope. So, you know, if you have pro forma rents that are, you know, in a range between, let's say, $1,000 and $1,300, a broker's probably going to choose the high end. You really need to delve in and see if you can actually achieve those pro forma rents.
Right. If your market will really get you those rents, because sometimes the broker will, you know, if there's actual and there's performa, you want to be looking at the actual numbers more so than the performa.
Absolutely, except for expenses.
Except for expenses.
Because
yeah.
you have to also realize in certain municipalities, you may have additional expenses upon sale. Like in California, for
Taxes.
instance, property taxes are, you know, if you look at the actual property expenses, you know, and which are true numbers,
Yep.
but the property is actually reassessed upon sale, which is
Right.
kind of unique within the United States. But you can have a huge, your property tax can literally go, you know, triple, quadruple on the sale, depending on when they last purchased the
Yeah.
property.
Yep.
So be aware of
And
actual
insurance.
expenses.
Insurance keeps going
versus
up
that.
like crazy now. Right?
Insurance is
the roof.
you're absolutely right, actually, and not to mention a lot of older buildings. Something to be aware of when you're doing your due diligence. A lot of the older buildings may have a insurance carrier, but it's grandfathered in for that carrier, so they're keeping them there. A lot of times, that same carrier will not reissue a new policy for a new owner because the building doesn't meet their current standards.
Yep.
And that could be something as simple as, you know, I know a lot of insurance companies were pulling out of any apartment building that had a Zinsco panel,
Right.
which is an older electrical panel that's been
Yeah.
known to cause fires.
Yep.
So know that, so you might have to upgrade your building, which goes to capital expenditures.
Well, one thing now, are we going
Yep.
to get into comps later on? Because
Yes,
I want to talk about not
absolutely.
going too far out. Okay, go ahead. Dan.
So capital expenditures. So with capital expenditures, you want to have an understanding when you look through the property, what the recent capital expenditures were. You know, did they replace the roof 2 years ago? Or
Plumbing, electrical.
Plumbing, electrical, HVAC. Or is it all older that you're going to have expenditures coming up within the next 2, 3, 4, 5 years, and you want to build that into your pro forma.
Yep.
So then as we go on, so typically what I like to do is on a property that we're looking at, we immediately go through all the major issues. You have, you know, the city, general, commercial, the zoning, parcels, walkability, transit scores, building size, lot size, APNs, what is all included in that. So then as we go on.
Well, let's talk
from
about
there-
walk score, what that is.
Well, walk score is essentially it outlines within the community itself what is within a walkable distance, and depending on what you have, it could be everything from how close transit is, how close grocery stores are, how close restaurants are. They take schools. They take all that in and determine, can you walk there or not? Is it walkable? So 79 is actually a very good walkability score, and that's actually good for
Goes up to 100?
in a multifamily. It goes
One
up
to
to
100?
100.
Okay.
Yep. And then transit scores, very similar. They just map out where all the transit points are, bus stops,
Right.
metro stations, things like that, and how close they are.
Okay.
So then as we move on, have a summary of the property. So this particular property was a 19-unit apartment building, currently has 22 units. Per LA County Public Records, only 19, so you have 3 ADU units that were added after
Right.
the fact. The property appears to be well maintained, little deferred maintenance. The exposed roof areas appear to be near the end of their life expectancy. Located on a major street with gated, uncovered parking, the subject property is underparked by today's standards. However, traffic counts are average to high for a residential building with close to 18,000 vehicles per day, and easy access to the 10 freeway, surrounding communities, Koreatown, shops, galleries. Community has all essential needs within a 5-mile radius of the property.
Okay, but this 19 units, now 22, 3 ADU units, they're all
Yes.
legal.
Well,
Because LA City passed a law.
LA City passed a law for the ADU units to add them in.
ADU means?
It's assisted dwelling unit.
Yes.
So
Or a grandma's unit. Or grandma,
kind of like a
grandpa?
grandfather's unit, yeah. So
Yeah. Their
it's-
grandfather's unit, yeah.
You can convert certain parking areas or add on
For
for
the
that.
garage.
It's to
yeah.
help with the housing crisis
Right.
that we're
Here in
having.
California.
Yep. So then as we go on, we start looking at the sales comps. In the sales comps, you typically only go back about a year or so in the sales comps. You can potentially go back to 2 years. Two things I look at. One is
That's far
first
back.
the for sale comps.
Yeah.
Okay. Now on the for sale comps, anybody can list a property for any price they want. So it's not really a good indication of pricing.
Right.
What it is a good indication though of is what your competition's doing. How can your property stand out if you're going to list it, or if you're going after other properties? How can it stand out compared to what else is out there on the market today? So you want to see what's there and take a look at it. And you want to compare very similar things as well. A couple things that you're going to look for is days on market. If it's a stale listing in a hot market, you know that it's overpriced, or there's something wrong with the property. You then start looking at age built. You want to make sure that you're comparing apples to apples, so to speak. So you try and find comparables that are very similar to that property. If you're looking at a 19-unit building, I probably wouldn't go lower than 16 units on the comp set and no higher than 25 to 30.
Keep it pretty close.
Keep it relatively close.
To the
Make
subject
sure that-
property.
To the subject property, absolutely. You want to make sure you take a look at all that. So, taking a quick look there, we're analyzing all of this to determine what is currently the competition in the marketplace.
Now, how far out do you go? I was looking at a setup last night,
Mhm.
and they had comps that were like 4 miles away.
Well,
That's a little too far.
I think it's much too far, depending on, well,
You want to be pretty close to the area you live in, because
Absolutely.
the subject property is in one area, and the comp was in a much, much nicer area.
Absolutely. And what you have to be aware of, this is where you really need to understand your market, and that you're buying the property in. Because some markets that are a little bit more tertiary or a little bit more rural, you can go out further.
Yeah.
Because it is what it is. But when you're going into like a high-density infill city like Los Angeles, Dallas, Chicago, New York,
Yeah, 4 miles is a different city.
4 blocks can be
Yeah.
a different city.
Yeah, exactly.
So you really need to understand that. What are the dividing lines within the neighborhood? Where are we looking at? And then you can kind of
Demographics
concentrate
need
into
to
that.
be the same.
Exactly.
Or similar.
Yes. So then as we go from there, we now start looking at the actual sold comps. So when we look at the sold comps, same criteria as far as area and type of properties, but we typically only try and go back about a year in past sales. So, we go back, we take a look at all of this. Now, these all look fantastic and great. This one looks like it's a new construction building here. These are a little bit older, but that may be because in that area, that's the only thing that was out there.
Yep.
So as we take a look, we're gonna make adjustments though, just like any appraiser would. When we analyze this, we're gonna make adjustments. And how we do that is by putting everything into a spreadsheet. So as we move on, and we start looking at the financial analysis, again, Summary on this property, remember back when we talked about certain things, we have one lot totaling approximately 10,108 square feet. You know, these are all the key indicators, key metrics that you're going to want to know. Overlays for the zoning, enterprise zone, community plan implementation overlay for the West Adams, Baldwin Hills, Lambert Park area,
Yep.
transit priority area, redevelopment project area, and a TOC Tier 2 area. So immediately that means, you know, I want to take a look to see if there's potential for redevelopment for this property. So we take a look at the zoning, what can we actually build on that property, do our analysis, what is the cost of land per unit, is it higher or less than the actual property as an apartment building? In this case, it's actually less, so it is at its highest and best use.
Okay.
So as we move on from there, so as we look at the other metrics that we're looking at, you know, we also have, you know, currently it's 1 improved structures, 19 units, this is all, everything that we talked about, but now we have the unit mix. We have 8 one-bedrooms and 13 studio apartments in there. Condition of the property is good, some deferred maintenance. It is subject to the Los Angeles Rent Control Stabilization Ordinance, and it's located mid-block between an apartment building to the east, commercial building to the west. Also note, where are the other services? Because one of the great things about this property, for instance, or for other multifamily, is it's right across the street from a fire station. So that's actually going to lower your insurance costs somewhat. Okay, so then as we move on, we have the sales summaries for the entire area. Now, remember, when you're looking at the summaries, this is encompassing everything. So it may have newer construction buildings, may have nicer buildings, larger, smaller, within that subset. So we're looking at this as a general, but we're going to now drill down into the actual type of building afterwards. But you'll see all the comp sets here. You have a 5.1 cap rate on average. Average sales price is $9 million in this neighborhood, in this area. Total sales volume of $27 million within the last year. There's only been 3 sales. So you had 3 transactions from 7.5 to 9.9 million. As we, 4 for sale listings in there with average cap rate now of 4.7, which is what you're going to expect to see. You're going to see for sale prices, maybe a little bit lower cap rate than what they actually sell for, because there's usually a negotiation in the price. So then as we move forward, this is what I mean by actually starting to figure out where we're looking at.
Right.
That 5.1 was a blended cap rate. And as you can see, you have a orange line, a green line, and a blue line. The orange line is a 1 to 2 star building. A 3-star building is for the blue line, and a 4 to 5-star building is the green line. So as you can see, the nicer the building, the nicer buildings are at a lower cap rate.
So this is like a Class A.
Well, no, the green would be a Class A, 4 or 5 star.
Oh.
So that's why it has a lower cap rate. The blue would be a 3-star,
So
which is typically newer,
more stars than
a
better.
little bit newer construction, a little bit less, some amenities, but maybe not all amenities as a new construction property that's out there. And then you have the 1-2-star, which are typically your older generational properties, typically built prior to 1980, that don't have a whole lot of amenities on site. If it has no amenities on site, you're down to a 1-star.
Yep.
Okay. So this is where we're at, and looking at this, it's actually a 5.13 cap rate is where we came across and found out where it falls. So that gives us a little bit of indication of what we can expect when we're looking to sell the property when we do the analysis. So then as we go from there, market sales price per unit, again, $249 for a 1 to 2-star property, which is this particular property. It jumps up to almost $400,000 a unit for a 3-star property, and for a new construction, like Class A property, you're all the way up to about $450,000 a unit. So you can understand now, when you compare the properties, you want to make sure you make adjustments for those price per units.
Oh, yeah.
So then as we go on from there, again, sales price per unit, inflation adjusted. This is just a graphic here showing what's kind of happening in the marketplace right now. We don't have Q2 stats as
Sure.
of yet, but for Q1 there was a small drop. Be aware when you are analyzing offering memorandums charts.
Yeah.
Okay, this chart looks horrible. It looks like we're in a steep down decline. Realistically speaking, though,
It's
it
not that
only
much.
went down about $4,000,
Yeah,
which was
it's
only
not that much.
which was only about 1.2%.
Yeah.
So be aware of how the charts and the graphs look, and actually study them. Don't just look like, hey,
Yeah.
this is a horrible chart. Oh my God, I better sell now, or I can't buy in this area because it's falling
Yep.
so quickly. So then as we move on, this is what I mean by actually summarizing everything.
Right.
So you'll see all the listed properties here, the 4 listings that we've had. We had a sales price, days on market, square feet, units, bedroom bath count, okay, which gives us a price per door. What we divide like in this case, it would be 48. We would divide the list price by 48, gives you price per door, price per unit, price per square foot, gross rent multiplier, cap rate if you know it. Okay? Recently sold properties. This again is where you're actually going to see, this is what someone was willing to pay. So it's a lot more reliable than what a property
yeah.
that's listed. So then we start looking at it and we start making notations. Like for instance, this property on Cochrane was completely vacant, needed refurbishment, large lot building size, better location but lower zoning. What you have to take a look at here is that, yes, completely vacant building, double-edged sword. You have the potential to get market rents relatively quickly, but you're also going to have the cost to bring those people, the tenants in, whether they're commissions and whatnot. And this building, for instance, as a needing refurbishment, it's also going to require some capital expenditures. Then you have another property, again, notations made there, and notations made on the third property. We then have a summary sheet here, and then as, if you can actually just scroll down a little bit, and you'll see that what we did, we have price based on averages right across the board here. But then we also make adjustments for location, zoning, unit mix, FAR, which is floor area ratio, and et cetera. And that gives us across the board kind of what's going around. As you can see, if I were to compare this property, because it's older, the price per unit, it should be worth $4 million. There's no heck in chance, no chance in heck, I should say. Yes, I know.
No way?
No way in hell. All right.
Okay,
fine.
we'll go with that.
That this property would sell for $4 million. I can promise you that.
Right.
So if you just use that price per unit, you're way off.
Yeah.
Instead, by adjusting for price per door, we're seeing that it's about 2.7 after making adjustments. Price per square foot falls down to about $2.2 million. But also remember,
Price per square foot at $2 million?
price per square foot adjusts down to 2.2 million.
Right.
But the reason for that is that most of these other buildings were actually larger unit sizes,
Gotcha.
unit mix.
Yeah, because
So
all these studios.
you get lower rent for on a price per square foot basis for a 2-bedroom
Yeah.
than you would for a studio. So, which explains why your cap rate is much higher. That with making adjustments for location, zoning, and everything else, down to $3 million. So in this particular instance, we're estimating that the price would be, as you scroll down just a little bit more. So recommended list price or sales price on this around $2,950,000, 2.9 to $2,950,000 is the expected actual sales price on this particular property as we do the analysis on it. So ultimately, that's what you really have to take into consideration.
Right.
It's not just one metric, it's all the metrics, how they interact with each other, and really coming to a point of what we expect that sales price to be for the property.
Now, I know you've created an Excel spreadsheet that you just pop everything in and
Yes.
it does it all out. And I think as an investor, that is something you should consider, and as an agent, should really consider putting a spreadsheet together. That way you can just kind of plug and play on the numbers all the time. Now, I got a couple of questions. Now, aren't studios singles, they're pretty transient, right?
Yes, absolutely.
So
Singles and
people
also
are-
1-bedrooms.
Yeah.
So when you're doing your pro forma analysis, typically speaking, if you're in a high density area, high city area, your estimated vacancy rate is probably about 3%. However, with a building that has
This many.
this many studios and 1-bedrooms and not too many 2-bedrooms, I would push that vacancy rate to about 5%.
Okay.
Even if the property is 100% occupied right now, what you have to remember is that, for every unit that you take on, if they move out every year,
Mm-hmm.
and it takes you approximately 2 weeks to turn it, get it ready, and have somebody move in, which is pretty quick to get it released
Yeah,
up.
make ready costs, marketing costs.
If every unit
commissions
were
if
to
you
turn
have an
over,
agent.
right there is just a 4% vacancy.
Yeah.
But if it takes a month, it's an 8% vacancy.
Yeah.
So, it's how many people actually move. Historically speaking, across the U.S., about 70% of renters move every year.
Yep.
Major cities, that's a lot less, because there's supply and demand issues at work.
Sure.
So, just be aware of that, so that when you are taking a look at it, so you can actually build that in. Even if the property's 100% occupied, it may not be your true number at the end of the year.
Yeah. Now, let's talk about amenities. What kind of, how do you put a value on amenities, or do you?
We do a little bit on the values of the amenities by adding.
Pool's really an expense that's pretty big, but.
Pools are expenses, but what we do and take a look at, when we take a look at the amenities, it's how does it compare to your other comparables in the area? If every building in the area has a pool, you better hope this one does too, because you're trying to attract the same renters. What we do is adjust. It's more on the income approach is how we do the adjustments on for the amenities, because typically speaking, a building that has a lot of amenities, whether it's maybe it's a high-rise building that has a gym, an Amazon locker, or a mid-rise building, newer construction, a gym, an Amazon locker, bike racks, a pet washing station, dog runs, all that stuff has any and every amenity you want. They're going to be able to charge higher rents than your other property. So we use that in the pro forma adjusting for the rents. And when we take a look at the amenities, what can we actually charge and get? So when you're doing your rental analysis and doing your comp set for your rentals and taking a look at the area, you can't just pick a building and say, oh, they're leasing it out for $2,500 a month, so I can get $2,500 a month. Take a look at what their amenities are and compare them to yours, because they may not be the same.
Yeah. Now, I know we're going kind of long, but I want to get two. Can you give me at least one item that you do when you look at a property to add value? Because every multifamily buyer is looking to add value, right? Extra income. What is one thing that you can think of?
The advice I would give is look for the trends in the area. And when you're looking to add value for the property, it really depends on what the property is and what's already there. For instance, there was a property that actually we bought.
You do the carports?
Yeah, and it had about 300. But this is the analysis I look at for it's the cost benefit analysis. In this particular property, we had 292 units. There were about 350 parking spaces.
Well, 200. How many units?
292.
Oh, it was 300 and something, wasn't it?
Yeah, just under.
Okay.
Yep.
It was under 400.
Yep. And then what we did though is every single one of those parking spaces was uncovered, and this was out in the
middle of Dallas.
In the middle of Dallas,
Summertime, wintertime.
Where you get potential hail in the winter, and you also get blazing hot sun in the summer. So what we did was we put carports in. But here's the thing: if we put carports on all 400 parking spaces, we couldn't sell them,
right?
Because you have to offer parking. We only put 100 carports up, and it was at a cost of about $750 per carport, so about $75,000 total. But what we did was we leased it out at $20 a month, which works out to $240 a year. So your return, you get that full return back within 3 years, but more importantly, on a cap rate basis, that $240 or that $240 actually increased the value of the property multiple times what it costs us to actually build the carports. So that's one thing I would look at.
And there was a list of people that want a carport.
Absolutely.
There was a long list of people waiting for it.
Yeah, but then also follow the trends. So meaning there are other ways you can do this as well. Like for instance, right now, especially if you're in a 1 or 2 bedroom apartment, and especially if the property is separately metered for water. One of the big trends right now is less people want dishwashers. They'd much rather have a washer dryer in the unit. So, especially if they're paying for their own utilities, you can actually get a washer dryer that fits right into that dishwasher, but charge them as a bonus or an added upgrade. So you can look, for instance, right now a built-in self-venting high-end washer dryer in one location that fits right into a dishwasher size, and you already have the plumbing there, easy to install. Plumbing and electrical is already there. Those cost about $1,300. So you could easily raise the rents $40 a month and say, if you want your own washer and dryer, it's going to be an additional $40 a month. We'll have it installed brand new. And again, cap rate basis more than pays off for it. So, and then lastly, something as simple. You can do things like Accent walls.
That worked brilliant for us.
Absolutely, super low cost. Just paint one wall, charge an extra $10 a month for it.
Well,
And-
what we did is we bought the 5-gallon
Yep.
drums of
Let
paint,
them
5
choose.
different colors, let them choose, and it was extra. We went anywhere from $10 to $25 a month, depending on, it was different
How many
apartment
walls
buildings.
and
Well,
what-
and what
yeah.
buildings, and then how many walls they want painted. So it was just, had that, and it was a quick,
Yeah.
10 minutes, we were out of there, but you're generating that extra revenue every month. So, all right, well, George, thank you
Absolutely.
for doing all this. I think next time maybe we'll do industrial properties. You want to do that?
Yeah, we'll take a look at them.
We'll take a look at some industrial. We'll come back and do an analysis for that as well. So thank you for tuning in. Now, if you haven't done so, make sure you also subscribe to the channel. Thank you.